afternoon, ladies and gentlemen, and welcome to the FMD Financial 2022 budget briefing. Our first guest today is perhaps a new one for our economic updates, but not a new one for FMD, and that's Jason Kalicha. Jason is one of our senior financial advisors in Melbourne, and has been with the business for, my guess would be 15 years now, Jason.
Or maybe getting close.
Getting close. And Jason's going to share with us a bit of an update on some of the budget outcomes. Many of you who will have seen our quarterly investment committee updates will know Mike Reynolds. Mike is director of FMD Financial, a member of our investment committee, and is certainly our resident, well, up until today, I'd say, is our resident interest rate specialist. But we've got someone on the panel, a special guest today, in Jay Sivapalan, who from Janus Henderson, who is a genuine fixed interest specialist, and that is his day job. Jay is head of Australian fixed interest at Janus Henderson, and he's also a portfolio manager for the Australian fixed interest portfolios. His responsibilities include formulating interest rate and sector strategies within the portfolios and working closely with key fixed interest clients. Jay joined Henderson's in 2015 as part of the acquisition of Perennial Fixed Interest. Prior to Perennial, Jay was at Mercer, where he performed actuarial consulting work. Jay has a BCom in actuarial and finance from the University of Melbourne, and he's a chartered financial analyst as well, with over 24 years experience. So we're very fortunate to have Jay on our panel today, and he'll be bringing us some insights in when we move to the economic section of today's panel. Thanks very much for joining us, Jay.
Pleasure.
Okay, Jason, I guess it's an obvious statement, but we got a pre-election budget last week. And with a pretty big focus on cost of living. Do you want to kick off with sharing some of the insights into that, and then we'll move on from there?
Yeah, so as you mentioned, Lee, wasn't the most exciting budget from a financial planning perspective. Sitting at home and watching the budget on last Tuesday night, it's generally not the most interesting thing to watch, but especially this last one as a pre-election budget was pretty quiet. But there were a few key measures that we'll go through today. The first that you touched on is cost of living support. Some announcements there. So the key one there is, so those that were recipients of the age pension or disability pension, or one of the Commonwealth Senior Healthcare cards and pensioner concession cards, as at budget night, which was the 29th of March, will be eligible for a government payment of $250 per recipient, and that's due to start flowing through from about the 28th of April. So timing-wise is pretty good on voters' minds as they're going into the election in May. So if you are one of those recipients, keep an eye out for that in your bank account from the 28th of April onwards. The other measure that the government announced is for low and middle income earners. So as you might be aware, there's something called the low and middle income tax offset. They've essentially added a little benefit on top of that for about $420, which takes the total benefit to about $1,500 for the current financial year. So it's expected to help roughly about 10 million Australians this financial year once they lodge their tax return. And then the last one, which is, I guess, topical at the moment with fuel prices, is the fuel excise has been reduced for the next 6 months by about 22 cents in the dollar for each litre. So pleasingly, driving into work this morning, saw some of the prices come down below that $2 mark, sort of sitting around that $1.70 mark. So that started to flow through, and that's designed to take a bit of pressure off everyday Australians.
Thanks, Jason. I didn't notice the petrol prices. I rode my bike to the office this morning.
Smart move.
I suspect, Jason, that petrol prices will go up next week just before Easter.
That's definitely true. Fill up today. Jason, one of the other announcements was in relation to pensions and minimum drawdowns.
Yes, that was one that was announced, slightly before the budget night, but as some of you would be aware that are drawing down on their superannuation, so have an account-based pension. Essentially, over the last few years, the government halved the minimum pension requirements, and that was to take a little bit of pressure off. People weren't needing to necessarily spend as much whilst we were in lockdown, couldn't do the travel, couldn't do the entertainment expenses and so forth. So the government's announced that they're going to be extending that for another financial year. So you can see in that table below, they're essentially halving all the normal minimum rates, which is a good thing. At the end of the day, it provides everyone with more flexibility to make decisions around how much they draw down. We are also understanding that some clients of ours have reduced to that revised minimum and want to go back now that we can start to do the travel and so forth. So the message here is really, look, get in touch with your advisor prior to July to have a chat around what you might change your pension payments to for next financial year.
Thanks, Jason. And look, I think they were the big impact superannuation changes, not that they were that substantial this year, but there were some pretty important changes that were announced last year that are now just coming into effect, and you wanted to recap on those?
Yeah, I was going to say that's probably a bigger or more interesting sort of changes that's happening. So a lot of them were announced in the previous year's budget, and they've recently been legislated to come into force from 1 July 2022. So the key one is they've removed the work test for non-concessional contributions, which are those after-tax contributions, and also for salary sacrifice contributions. So essentially, currently, to be able to make those contributions, if you were 67 years or older, you would need to meet what was called the work test, which is 40 hours over a 30-day period of work. They've removed that now, which provides a lot more flexibility for clients to be able to add money to super either once they've retired or all the way leading up until 75. That's a real key benefit for clients. And the other thing that they've done is also allowed you to bring forward 2 years worth of contributions all the way up until 75. So in summary, it allows clients that are under 75 to contribute a lot more to super. And also there's another strategy which some of you may be aware of, which is called a withdraw and recontribution strategy, which allows you to essentially reduce the tax that your adult children might pay if your superannuation was to ultimately be passed to them upon your death. So this opens up quite a significant strategy all the way up into 75 that can potentially save your adult children hundreds of thousands of dollars. So worthwhile speaking to your advisor around the opportunities there. And then the last one, as shown on the slide, is the downside of super contribution. So this was something that was announced sort of in the last 5 years, which allowed essentially retirees that are downsizing their home to get money into super. Previously, you had to be 65, or currently, I should say, you have to be 65 or older to be able to use the downsizer contribution. Pleasingly, the government announced and has recently been legislated where essentially you now only have to be 60. So they've reduced it by 5 years to be able to take advantage of that, that downsizer contribution rule. And it is also worth just noting, most people think of their primary home to be able to take advantage of the downsizer contribution. But for some people, they might have an investment property that they've owned for over 10 years. And there was a small portion of time in there where that was their primary residence. That actually qualifies as an opportunity to use that downsizer contribution. So again, something worth speaking to your advisor around.
Definitely worth asking, especially with Melbourne property prices as the way they are at the moment.
Not a bad time to be cashing in.
Yeah, absolutely. So thanks for covering those changes, Jason. Perhaps if we go back to the budget momentarily, there were a few sweeteners for small business in there.
Yeah, so on the small business side of things, as you mentioned, there were a few small things that popped up. One of them is there's going to be some small business tax benefits, along with access to 120% deductions for upskilling employees and going digital. So these are things like assisting with the cost of devices, cloud computing and cybersecurity systems. There was also an announcement around some employers are providing their staff with COVID PCR or RAT tests to allow them to be able to come into work. So that's going to be tax deductible for employers and not be caught in the FBT section. And then finally, for apprentices, so the government's spending an extra $2.4 billion over the next 4 years for a bit of a revamped apprenticeship scheme. So it replaces a scheme that's due to end on 30 June this year and include wage subsidies, hiring incentives, cash payments, and those type of things to help really stimulate the economy.
Thanks, Jason. Now, we talked a little bit before about Melbourne house prices and how high they are. There were some small measures in there in terms of trying to support first home buyers. Have you got any comments on those?
Yeah, so there's no major changes there. They're really tinkering around the edges, but one of the key things is there's a home guarantee scheme, which is for some first home buyers that meet a certain criteria, rather than needing the full 10 or 20% deposit without paying your mortgage insurance. There was the scheme allowed a certain amount of participants to benefit from a lower deposit required. Essentially what they've done is they've broadened out that. So they've proposed and expanded another 50,000 places and another 35,000 places per year ongoing. So a bit of extra support there, but as I touched on at the start, not significant changes around that area.
Thanks, Jason. So we saw in the budget, as we've spoken about, some cash splash for individuals, but there's some pretty big ticket spending items as well in terms of infrastructure. Can you give us a bit of a run through of those?
Yeah, definitely. So the main ones that come to mind is there was about 18 billion of new road and rail projects that they're going to be spending on. So infrastructure is always a big one that helps stimulate the economy, create jobs. The other one is a 15 billion spending on defence. Pretty topical why we'd need to be doing that in the current environment. So not a surprise that one's coming through. And then the interesting one was about 9.9 billion on cybersecurity. So that seems to be the space where there's a lot of attention, and I guess where there's a lot of things happening in the geopolitical side of things there. So an important one to be spending on, and that could create a lot of opportunities for jobs going forward.
Great. Thanks, Jason. Really appreciate that quick update, and we will ask you to hold on for questions towards the end.
And Lee, one more thing before we sort of wrap up is that I just want to touch on is there are a few other small things that's just worth reminding you around. Is the first one is a 1 July this year, super guarantee contribution. So think of your employer contributions. That's jumping up from 10% to 10.5%. So just keep an eye out for that. I imagine if you're an employee, your employer will be in touch around what impact that has on your salary package. And the other one, which is still a bit further down the track, but is an important one just to remind people, is the changes in tax rates. So the big one coming through from 1 July 2024. So at the moment, there's obviously different tiers of tax rates, but the big change will be from someone earning 45,000 all the way up to 200,000 will have a flat tax rate on that amount of about 30% plus the Medicare levy of 2%. So at the moment, that ranges from somewhere between 34.5% up to 39%. So it's a pretty big, significant tax saving from 1 July 24 to keep an eye out for.
Yeah, thanks, Jess. A really important one to point out. Okay, well, thank you for that budget update. And as I said, please hang around so we can, if we have any questions around the budget measures, we can come back to you. Really interesting. You talked about, Jason talked about the increased spending and the infrastructure spend and so forth in the budget. And so if we move on to the future implications of the budget and the economic situation, I suspect that the federal government was able to commit to that level of spending on the back of perhaps stronger GDP numbers than originally anticipated. And Jay, if I could go to you, perhaps could you take us through what led to that and what you see happening in that regard?
Yeah, sure, Lee, and good afternoon to all of the audience as well. So when we think about where we are in the economic cycle, we are 2 years on from the onset of the pandemic, and I think it's fair to say that we haven't necessarily dug ourselves completely out, but nevertheless, the Australian economy, along with many other global economies, are recovering really well. So for Australia's part, we're expecting this year growth of somewhere between 3.5% and 4% for the broad economy, which, just to put that in context, is almost double our natural GDP potential. So quite a good, robust year. And that should get us, before the end of the year, back to pre-COVID levels from an economic growth perspective. Now, what that's meant for the government is clearly tax take and higher levels of tax contributions, not necessarily in terms of the rates, and I think Jason did a really good wrap-up of where rates are heading, but just no more complex than more people working, more hours, and greater levels of participation by individuals. That, coupled with what's going on the commodity side of things, where we are experiencing and enjoying very elevated levels of prices for our corporates that are operating in the mining sectors. That's also boosting federal government taxes and tax revenue. Similarly, at the state level, the housing market has been relatively strong and the turnover has been relatively strong. So again, stamp duty, tax collections. So all of this has really set up the government to be able to provide some of these tax incentives, tax spending and government spending. And the best way to really characterize all of this is that growth has led to a series of pro-growth policies, which has been, again, good for the economy on a forward-looking basis.
Great, thanks, Jay. So we think about spending. We see SG contributions going up 0.5%. Prices going up all over the place. Inflation is obviously a pretty big topic at the moment. What are the risks? What are the opportunities around inflation? And Mike, feel free to jump in here at any point as well.
Thanks, Lee. Look, I think we discussed this in our investment committee meeting that we broadcast to clients a few weeks ago. I mean, central banks around the world have had pretty much since the GFC, in which we've had a decade of progressively decreasing interest rates, and COVID really was the nail in the coffin, where interest rates basically became zero. Negative interest rates in Europe, which is unheard of. And so we're now at the point in the cycle where central banks start to unwind that zero interest rate environment we've been used to. And to give you some context around where interest rates have moved to, so 10-year government bonds in Australia today are 2.96, which is a very, very long way from where they got to. I think at the peak of the pandemic, we were down at around 0.7 or maybe even 0.65 for a 10-year government bond. So that rise in interest rates is ultimately designed to slow demand, and the challenge for all central banks, and I'll talk about inflation as my last point, is that the uncertainty around COVID and all those things are still not, I think, completely behind us. And so central banks want to be cautious around the rate by which they raise interest rates to slow demand. But equally, the shutdown of supply chains around the world caused by, and right at the moment, you've got Shanghai in a complete lockdown around their COVID sort of increase in numbers. And that whole supply chain disruption for motor vehicles, building materials, etc., has really created a supply-demand imbalance. Cost of prices have gone up for everything, or lack of availability has forced prices up. And then equally, the conflict in Europe, which has then appeared out of left field, and Russia is a massive supplier of energy to Europe, raw materials, commodities, etc. So the price of all those things have risen as well. So that supply chain inflationary pressure is really causing some uncertainty around how assets are valued, and that rise in interest rates will ultimately have some effect on the valuation metrics for their equities and infrastructure assets to some degree.
Thanks, Mike. So Jay, I know that this is your area of specialisation in terms of interest rates and their impact. So have you got anything to add about particularly how fast interest rates might rise and the impact of that?
Yeah, so I guess just to extend on Mike's comments about inflation, the way we tend to look at inflation is the supply side inflation, which Mike did a great job of explaining where those sources are, and then the demand side of inflation. And certainly from a central bank perspective, like the Reserve Bank of Australia, it is really the demand side that they're focusing on. And that's largely been why they've been patient, and I'll get to that in a moment. But just to quickly talk about where demand side inflation starts picking up, it's usually when the economy is very robust. Today, we sit with not far off 50-year lows in unemployment in Australia. Obviously, in the US, they have already reached that. And so we are starting to see the demand side inflation picking up. And that's no more complex than what we're all about to do next long weekend, which is regardless of the price of petrol or accommodation or whatever, we've all been locked up for a couple of years. We want to go on that mini break or holiday, and we will pay whatever the prices are to go on that holiday. And that's where the demand side kicks in. And I use that example, but you can think of that from a restaurant perspective. You can think of that from a healthcare cost perspective. You can think of that from a variety of reasons. So this audience would be, all too familiar with inflation, and inflation is always a basket, but I'm sure for this cohort, inflation has been higher than the printed CPI over the last few years in terms of healthcare and other services. Looking forward in the near term, we are starting to see inflationary pressures come through the economy. The one that the Reserve Bank is really focused on is wages inflation. And the reason that they're focused on wages inflation is because if you think of that decade between the GFC and COVID-19, they were cutting rates and they still couldn't stimulate demand enough to cause a really tight labour market. And it was never about the unemployment rate, but it was about underemployment and underutilization. And therefore, we never got our wages going up enough, and they never got a chance to raise rates. The reason they've been much more patient this time around, and a lot of global observers have asked, well, all other central banks are raising rates from emergency pandemic measures. Why not the RBA? And that's because they've got this golden opportunity to really try to tighten the labour market enough to get wages inflation going. Now, of course, the trick is always to not overinflate and not to have too much inflation. So that's on inflation near term. I just want to make a very brief comment about inflation more medium to long term. And that is, are we in the middle of a structural or a regime shift? 3 or 4 years ago, everyone was talking about the Japanification of the world, debt, deflation, and demographics, and why inflation was going to be very low. And then now many investors and commentators are talking about higher levels of structural inflation. And we don't yet know whether we're in one of those regimes or not, but certainly the markets are starting to price that in, and I'll bring that back to cash rates in a moment. But what are these structural factors? The key structural factors are, one, the enormous amount of money that needs to be spent on resolving climate change, and that effectively means electrifying everything we do. So electric cars, solar panels, etc., which does cost money and therefore is inflationary. The second one is we've had this very steady state in terms of the East trading with the West. So the trade arrangements that we've had over the last 3 or 4 decades, which is now being shaken up. And will we see the big US consumer no longer relying on the factory in China, but rather focusing more on Mexico, or a European consumer in Poland or otherwise? And that can be inflationary as well. And the third part, which Mike touched on, is the geopolitical tensions. We've been in a steady state for 70 plus years without a world war, and I'm not at all suggesting that we're about to embark on one, but certainly there are some risks around the place. So these are the things that we think about from a medium-term perspective. Now, just to quickly bring this back to markets, what markets have done is taken fright and hold of an inflationary theme and effectively priced in a very quick, robust, not only a reversion of cash rates in Australia from pandemic levels back to normal, but also to tight policy. And I'm happy to comment, but I might pause there, but I'm happy to comment on what markets have actually got priced in.
So I think just, Jay, if you want to keep going on that, I mean, we're really interested in, what is the future of interest rates? I know you've got a little slide here that you perhaps might want to talk to. Do you want me to bring that up now and we go to that?
Yeah, that would be great, Lee. So perhaps if we start on slide 13, and it just goes to show you how quickly markets are moving, even from this slide, And in the context of the last 2 or 3 days, things have changed quite dramatically. So what these charts are, and perhaps if I can just focus on the right-hand side for the moment, which is Australia, this is the market's expectations of cash rates on a forward-looking basis. So in other words, that's what's priced in. And if I were to update this chart to today, essentially it will tell you this. Firstly, by the end of this year, 2022, the RBA would have tightened policy by 200 basis points or 2%. So effectively the cash rate by the end of this year would be 2%. And by the end of next year, the cash rate would be approaching 3.5%. Now, just to put this all in context, pre-pandemic, in 2019, the average cash rate in Australia was about 1.25%. And just before the pandemic hit, we had a cash rate of 0.75%, if you all recall back, just after we had that bushfires just before the pandemic hit. So this is an incredible amount of tightening that the market has priced in. Just to translate this into what it means for households, as we all know, one of the areas that we have, like it or loathe it, excelled in is household debt. We've got an enormous amount of household debt, circa $2.7 trillion to be precise, which is very high by global standards and by historical standards here. We also have a situation at the moment where about 40% of all mortgages in Australia are fixed rate. And there's a hump of maturities in those fixed rate mortgages in the fourth quarter of next year. So that's between September and December 2023. So if you marry these together, here we are, we're going to have a situation of elevated household debt, elevated house prices driven by record low interest rates, and the market now suggesting a 3.5% cash rate, which means a standard variable mortgage rate of about 6% by the end of next year. And it's almost a perfect storm. So for that reason, we don't believe that this will actually be able to be realized by the RBA. And we think the RBA is likely to tread a much more cautious stance as they have been. And perhaps, Lee, if we can just move to the next slide. So you can see there in the dark blue color in the middle, that is our expectation of where cash rates might head over the coming period. And perhaps if we just focus on the next 24 months, we think the first 100 basis points of tightening can come reasonably quickly by the end of this year. And then from there, the Reserve Bank of Australia is likely to take some feedback from the economy just to see what has that done to households and consumer spending, and in particular the small to medium enterprise, the SME sector, before they continue on that journey and tighten policy by another 75 to 100 basis points through the course of next year or the year after. So much more gradual. And just to put that all in context with what the market's priced in, the current tightening profile priced in has never occurred in Australia in the context of the last 30 odd years when the RBA has had this inflation targeting regime. Now, in a moment, I want to talk about what type of opportunities this creates for investors because, in particular for the retiree market who have suffered from very low term deposit rates and very low bond yields and very low yields on fixed interest as an asset class over the last 2-3 years, there's suddenly a fantastic light at the end of the tunnel because it gives them an opportunity to lock in what the markets are priced in today.
So I think that's a really valuable look into the interest rate risk, and we can see it. I think most of us can get our head around as the fact that if interest rate rise, the demand for housing price might decline, and maybe Melbourne is getting close to a peak in that regard. But it would be, if we move beyond the residential property market, what are the investor implications for this? And Mike, I'm not sure if if you wanted to start there and start to talk about, well, what's the FMD investment committee thinking about in this potentially rising interest rate environment, what we start to consider from a big picture investment committee perspective.
Jay's comments are pretty much the same view as our investment committee positioning. Our broad view is, I think it's very difficult for central banks to materially raise interest rates too quickly and do, you could do an enormous amount of damage to an economy in a very quick time frame after you've really had a decade of sort of government support to try and keep economies on track post, GFC, and then, every other calamity we've had around the world, not to mention the pandemic, which is still ongoing. So our view has been that the market's view around the pricing of where interest rates back up to is not going to be as severe as what has been priced into bond markets currently. From an investment committee point of view, we made some changes which we articulated last month in our last video we did around the duration and the composition of our fixed interest managers. Our managers are more active in terms of broad, what we would call diversified fixed interest managers. So they're not set to a particular level of duration. So as interest rates rise, longer dated bonds suffer bigger capital losses in the sell-off, and shorter dated bonds don't suffer quite as much. We suspect that the short-term end of the interest rate cycle, or that's the interest rate market, which is that in Australia cash to sort of 2 years, is going to come up closer to where interest rates are at the 10-year curve, so we call that a flat yield curve. In the US at the moment, we have an inverted yield curve where short-term rates are actually now slightly above 10-year bonds. That, from an economic point of view, a traditional economic point of view, is a sign of a forthcoming recession. Not so sure whether that's a likely scenario. I think that's an unlikely scenario personally. But here in Australia, our yield curve is still somewhat normalised, where short-term rates are lower than longer-term rates. But we see that sort of equaling out, I think, over the next between now and the end of the year. So just in reiterating what we've done with AMS in our portfolios, we exited our position in bonds late last year. We didn't avoid all of the sell-off. We wore some of the loss, but that was there as a defensive portfolio. We overweighted our position to infrastructure assets. So the demand destruction for infrastructure assets like airports and toll roads around the world, which have basically been shut down because of COVID, we still see an opportunity for that recovery process. And I think the takeover bid for Sydney airports at $8.75 is a reflection of sort of the longer term demand for those quality monopolistic assets that infrastructure managers look for. And we are still overweight equities, because we still think on a relative basis, equity markets still, although not cheap, we still think that they are priced to give us a return that's better than fixed interest markets in the medium term. And we'll, as we always do with our process, continue to monitor and change opportunities as markets fluctuate. And I think perhaps from Jay's point of view, which I'm unaware whether he's going to make this comment, I think this sell-off in longer-term interest rates now, I think, are getting back to a point where they start to look attractive, because markets always tend to overreact, both on the upside and the downside. And so when fixed interest rates sell off aggressively, anticipating a future event, and they are wrong, well, they quite often go too far, and that may be an opportunity for our active fixed interest managers to take advantage of that and generate some returns.
Thanks, Mike. That's a really good summary. So in terms of trying to take some of the sensitivity to interest rate rises out of the market, out of our portfolios, opening up that infrastructure opportunity, which we see the government's chucking money at as well at the moment, and being open to the growth in equity. So that's where we're positioned. Jay, perhaps at risk of letting you challenge some of those perspectives, can I hand over to you and get your perspective on what you see, from the opportunities and growth coming ahead?
Yeah, sure. And look, I think prefacing the comments that I made earlier, we are in a growth upswing. So economic growth is a positive environment at the moment. And so when we speak to companies, obviously we're speaking to companies from a credit investor perspective, in other words, lending money to companies as opposed to equity holders. But we are seeing that the earnings of companies in Australia is tracking up. So there are genuine earnings growth going on, and we will likely see that going forward. One of the comments that Mike made earlier about, what does it mean for companies and corporate health when you've got a rising rate environment? And the point I always make is when you're going from easy policy to neutral policy, that in itself is not so bad. It's not necessarily meaning that the central bank is trying to really act to slow down the economy. It's when policy goes from neutral policy to tight policy, that is the true act of slowing down the economy. And that's what we saw just before the GFC when the cash rate was lifted to 7.25% here in Australia. Of course, we were in the middle of a mining boom at that time and very different fundamentals. But certainly when we talk to corporates today, whether it's property trusts or REITs, whether it's our banks, whether it's the Woolworths and Coles of the world, etc., their earnings are all growing. And I think that gives us quite a bit of confidence about the outlook for what we would call growth assets. Now, the one small caveat that I would make is that all of the policy support that we've had in the last 2 years has increased the price to earnings ratio. In other words, for a given level of earnings for any company, the level of price that you're having to pay to buy that earnings has increased. And so what we might see is that increase no longer holds and it sort of normalizes whilst earnings are growing. But nevertheless, I think it's still broadly a constructive view for growth assets. And that really is on the back of a much more measured Reserve Bank of Australia, who are only tightening policy enough just to take the slack out of the inflation side, as opposed to trying to really put the handbrakes on. I think it is worthwhile also flipping the coin on the other side and talking about the defensive assets. And perhaps, Lee, if I can just ask you to share slide 15. And that is, what's changed for defensive assets? Mike already alluded to many of these aspects, but there are 3 charts there on the top. So if I can start off on the left-hand side, the government bond yield. So this is effectively the truest risk-free yield. And as we all know, this is only for a 3-year term. This time last year, that yield was not far off 0%. And today, it's over 2%. The next bucket, which is the middle one there in blue, that's what we call the swap spread. But it's essentially, what that means is it's the additional reference rate above which companies borrow money. And you can see that's also increased by about 0.3%, as a lot of the tailwinds of policy and the tide goes out from the policy support. And then the last one on the right-hand side, this is just for a major bank. So just think about the Commonwealth Bank of Australia. A year ago, they were getting the benefit of the policy support of the TFF, the Term Funding Facility, and another facility called the Committed Liquidity Facility, or CLF. Now, those policies are starting to be withdrawn and the tide going out. So they're having to pay a more natural market pricing for borrowing money, and that's that orange line. So as an investor investing in fixed interest, it's actually the combination of these building blocks that is the all-in yield that investors get. And you can see on the bottom panel there, that's the all-in yield that investors were receiving, say, 12 months ago, which was about 0.5, 0.6% for lending money to a safe company like the Commonwealth Bank of Australia on a senior basis. And then if you look at it today, right here, right now, we're getting a yield closer to 4% on that same bond. So there's been a fundamental shift and repricing of defensive assets. in the AMS portfolios, the active management services and funds, one of our products are used, which is the Tactical Income Fund. And so a couple of things we've been doing there. Over the last year, on the back of rising bond yields, fixed interest, even as an asset class, is down about 5.5%. In contrast, the Tactical Income Fund that we have and is employed as part of AMS, that is much closer to 0% drawdown. It's about 0.5% drawdown over the last year. So it's preserved capital much better. But now is the time to really swing from preservation of capital to looking at this opportunity and everything that we've seen to now employing risk in the portfolio, even from a defensive perspective. And that's what we've been doing over the past month or two. So the yield to maturity of the fund has gone from just over 1% this time last year to today about 4.6%. So quite a considerable lift in bond yields. Now that's important for two reasons. Obviously for retirees like yourselves, you are now getting paid well even in defensive assets, which wasn't the case 12 months ago. And the second is if we do get, for whatever reason, a GFC or a COVID-19 tomorrow and equity markets are down, suddenly the defensive characteristics in fixed interest as an asset class have been restored and bond yields can fall again at the next recession and prices will rise and really play that diversification role. And that's really the reason why groups like FMD in their AMS portfolios use fixed interest in combination with growth assets.
Yeah, thanks, Joe. That's a great explanation of that role in the portfolio. Thank you very much. Well, that might be a good spot to, I guess, pause our presentation and ask for any questions. Please, if you do have a question, just pull it into that Q&A box and type away, and I'll be able to see that. There is one question in there at the moment, which is simply asking if we'll have a copy of the slides available afterwards, and of course we we'll provide that with the video of the event.
Perhaps Lee, I might just one thing that Jay mentioned, which I think's important around, not so much for our clients, but maybe the children of our clients, is that the cost of mortgages in Australia is clearly going to come under a bit of pressure this year. Jay mentioned the term funding, TLF, the term loan facility that was available to the bank. So the central bank here basically provided a window where banks could access cheap money during periods of volatility, which then allowed them to keep lending the economy, but still make sufficient profit margins so the banks actually, were still profitable. And as that is removed from the environment, then the cost of the bank's funding mechanism or how they fund their mortgages goes up. Our banks here domestically collect about 50% of their funding needs from offshore, and higher interest rates offshore means that cost of funding for banks goes up. And so, the challenge for the central bank here, Reserve Bank here, is to not raise rates too much so as the cost of mortgages go up too quickly. And because of, as Jay, aptly put, we're probably the most indebted country in the world for mortgages. And so house prices, I think, are definitely going to plateau. They might have already reached the top here in Melbourne and maybe on the way down. But I think the cost of mortgages for people that are relatively heavily borrowed is going to come under a bit more pressure, and that's the challenge for how the economy deals with those things.
Thanks, Mark. So we do have a question, and I'll leave it to, maybe I'll put this to you in the first instance, Jay. But the question is, do we think that the pending federal election will have any bearing or impact on interest rates?
Yes, always a tricky one because I've got to make sure that I don't pick a party accidentally. But, no, look, I think when you think about the policies that are being put forward by the coalition as well as Labor, and I'm I guess already assuming there that they are the two parties that we're talking about, they're not necessarily gravely different. It's very different to the policy that the Shorten government was proposing at that time around negative gearing and capital gains tax and so forth. So they are both effectively relatively pro-growth, albeit nuanced in where that growth comes from. And I think the differences will really come around either focusing on infrastructure spending versus some of the regional spending, affordable housing, and healthcare costs, etc. So that's where the differences are. But the overall picture, I believe, will be quite similar. And the prospects for the Australian economy, at least in the near term, 2022 and 23, are broadly similar, which is a positive one.
Right. Okay. So nothing, not too diverse there. Jason, if I can come to you, we've got a question about the work test changes and the super changes benefiting our clients' children, which I think might be more directed to a withdrawal recontribution strategy.
Yep. Okay. So just elaborating on the work test changes. So as it currently stands this year, if you are 67 years or older and you are not working, you're retired, you're not able to make any further contributions to superannuation unless it's a downsizer contribution. So you sell your home and contribute part of the proceeds to super. So this is, a lot of our clients have retired by the age of 65, and it's sort of closed their ability to make contributions to super from that point onwards. One of the changes is they've removed the work test, which is that having to work 40 hours in a 30-day period if you're 67 years or older. So you no longer have to meet that condition from 1 July 2022. So let's just, in simple terms, you've got a client that's retired, is 72 years of age, has some money sitting in cash outside that they've either, could be an inheritance from a parent that's passed away or some other source of funds. You've now got the ability to potentially contribute that to super, subject to super caps and things like that, which I won't go into too much detail about that, but it's opened up a window where now being over 67 and not working, you can contribute up until 75 years of age. So that's the first part there. In terms of the tax savings for adult children, this is quite a technical area, but I'll try and keep it relatively simple for the purpose of this. And in terms of your superannuation, there's two main components. There's a tax-free component, which is generally when you've made additional voluntary contributions. So think of non-concessional contributions over your lifetime. And the bulk of superannuation is generally what they call the taxable component. So they're your employee contributions, your salary sacrifice contributions, your earning on superannuation and so forth that's built up over time. So it's that taxable component bucket that if you were to pass away and the proceeds were ultimately paid to your adult children, there could be tax of up to 17% on that taxable component. Okay, so depending on what your balance is, that can be quite a significant amount that a lot of people aren't aware of until, unfortunately, they've passed away. The kids are advised that there's a tax bill, essentially the super fund pays, and they're left with the rest from that point onwards. Now, there is an opportunity which is called a withdrawal and recontribution strategy, and we've done I'm pretty sure we've done a webinar on that with Nicola Beswick and Michael Russell. So we might be able to direct you to that, which goes into a bit more detail, but it essentially allows you to withdraw some of that taxable component. So it comes out, goes into cash, and then you contribute that back into superannuation. Now that some people will have an extra, let's call it 7 or 8 years to get that money into super, goes in as tax-free and helps reduce the potential tax paid on that taxable component. It is quite a complex area. So what I would encourage you to do is really speak to your advisor. They can go through all the details around, one, whether there's a benefit in doing it, two, whether you've got the ability based on caps and things like that. But it's definitely something that's opened up as part of these changes of removing the work test. So worthwhile exploring.
Thanks, Jason. And obviously, we've been talking about those opportunities a lot internally, and your advisor will be considering that at your next review as well. This isn't something that needs to be acted upon today. There's plenty of time, but unless I guess you're very close to 75. But for most of our clients, there's plenty of time, and but please pick it up at your next conversation with your advisor if it's not raised with you. Okay, well, we're getting close to time now, so unless someone has something that they'd particularly like to contribute from our panel that we haven't touched yet, I might simply say thank you to all of you for your contributions today. I think whilst not the most exciting budget, some important facts, Jason, thank you for sharing. Mike, thank you very much for your interest rate. Jay's given you a run for your money on your interest rate commentary today, but thank you for your contribution. Jay, thank you again for joining us. We really value having the input of people who are contributing to our clients' portfolios in these events, and it just brings a little bit more to life. And I think you not only shared some great insights into what's likely to happen around fixed interest and interest rates, but also into the process and the role of bond funds in our portfolio. So thank you very much. One last question's just snuck in. So I think we've got a moment. So it's a currency question, and perhaps someone who's thinking about heading overseas, as many of us are now. But in light of what we've discussed today, and I know currency questions are always tough ones, but in light of what we discussed today, is anyone prepared to venture a view on the Aussie dollar versus the US dollar or the euro, and which way it's going to head?
It's a brave question, and I'll try to be brave answering it, but I will disclaim right up front that I'm not a currency expert, but I can certainly give you my thoughts. So, I mean, I think the question was for over the medium term. So let me try to answer it from a medium term perspective. If I look at the three economies, the US, Europe, and Australia, in that sort of segment, and the relative strength of those economies, barring some sort of policy mistake and barring some sort of war and some sort of issue, of the three economies, the US is the strongest at this moment in time and likely to continue to be quite strong, followed by Australia, followed by Europe. Europe, for a variety of reasons, is, we feel, going to be the laggard in the recovery, albeit they have recovered pretty well from the pandemic, but they still have a number of structural issues that they're still working through. So from that perspective, we do expect the US dollar to continue to perform well. And if you think about the interest rate differentials, the US is one of those economies where they can get to a 2.5% interest rate or cash rate, whereas in Australia, we're going to be a bit slower getting there for the reasons that we outlined today. And it's really around the difference in household debt between the two countries. And then, of course, Europe. Now, of course, what's unique about Australia is that we do enjoy commodity prices which swing around, and when we have high commodity prices, regardless of how low or high our interest rates are, our currency goes up with it and vice versa, and we're seeing that episode at the moment. So commodities got a lot more in the medium term to do with the structural changes that are occurring in China. So that's probably the wild card, but leaving that aside, we would suggest the US dollar continues to appreciate relative to Australia, and Europe a bit more of a laggard.
Great. Thanks, Jay. Okay. Well, look, I think I'll leave it there considering time. Thank you all again, our panelists, for your contributions today. Incredibly valuable insights. And I'll just restate that if any of our clients participating today have any questions, please go direct to your advisor, and they'll be able to assist you with helping you understand any of this in more detail or just the impacts on you personally. So thanks very much today, and we look forward to seeing you again for our next session. I might note that one of the coming sessions will be, we'll bring another guest in from Janice Henderson to talk about ESG investing a little later in the year. So I'm looking forward to that, and so stay tuned for more information on that, and thanks again to Janice Henderson for their support today. Thanks, everyone.